2018 is off to a flying start for global markets, with record levels on stock markets and upward revisions to growth forecasts. But what does this mean for Australia's economy and our interest rate and equities outlook? A quick update on our expectations for this new year. Fresh record highs for stock markets in the USA, Germany, the UK and Hong Kong in January have 2018 off to a great start. And as we noted in December, equities and the global economy have solid momentum, with stronger growth creating tailwinds for Australia through trade and offshore demand. Our stock market hasn't been quite as buoyant, but is still trending higher, and commodity prices are well elevated, with the iron ore, coal and LNG spot prices all well ahead of the assumptions that went into the federal mid-year budget outlook. As for where these prices trend from here, we shall see. But the pickup in global growth and sentiment is helping, with the elevated oil price a good benchmark of this trend. In line with this improvement in confidence, bond markets around the world are under pressure as interest rates rise, with 3 to 4 more rate hikes expected in the US this year, another rate hike in Canada already delivered in January, and Europe is scaling back its QE stimulus. So with our jobs market still performing strongly and elevated business confidence, when will the RBA be lifting Australian rates? The latest CPI figures didn't seem to add any urgency at all to this, despite better retail sales and consumer confidence data released in January, with inflation coming in at 1.9%, still in line with the RBA forecasts, but no clear sign that inflation is about to move higher, and certainly not via wages growth, which remains very weak. So no need for our Reserve Bank to follow the lead from overseas tightening yet, but there are risks in leaving rates too low for too long, and the RBA won't want to get too far behind the curve on inflation, especially with the oil price moving higher. We've still got an RBA rate hike pencilled in for August, although that might need to be pushed back to November depending on the coming month's data. And that timing is also dependent on exchange rates. For some months now, we've called the Aussie dollar to remain in a 75 to 81 cent range, but having obediently traded that way throughout the 17-18 financial year, we're close to actually breaking higher, thanks to the weaker US dollar. Why the US currency would weaken while facing further rate hikes and record stock markets has many confused. But we think there is more weakness likely as the short-term sugar hit of the Trump tax cuts are replaced by the longer-term implications of a weak US fiscal position, on top of the impact of protectionist policies. But more importantly, it's actually the trade-weighted index that matters for our exports, rather than just the Aussie and US dollar terms. And that index remains pretty benign for now, so still a help to our goods and service exports. All fairly positive news, and we'll see what the RBA have to say about all of this in their statement of monetary policy next Friday. Until then, that's the market update from Bendigo Bank.